Most of the time, as I've explained earlier in this course, we treat the market price of stock as being fair. It's not the right price, but it's the fair price. It's as likely to be too high as it is to be too low. With an initial public offering, or IPO, though, all bets are off. When 3Com's Palm division had its IPO on March 2nd, 2000, it went from its offering price of $38 to over $95 on the first day. If you're scoring at home, that's a 250% return in one day. By comparison, the S&P 500 barely budged, inching up less than 0.2%. Palm outperformed the S&P 500 by not quite 1,400 times that day. What in the world is going on? How do IPOs work anyway? Is that price behavior typical for IPOs? That's a fabulous one-day return, but what's the long-run performance like? It turns out that the pricing of IPOs and their expected returns and risks are nothing like those of securities that are already trading. If you understand how and why companies go public, then you can better assess the benefits of investing in IPOs and those risks. Let's start by decoding what the name Initial Public Offering means. What is an IPO anyway? Like so much of financial terminology, we benefit because the language evolved from what people use on Wall Street and financial markets. We can figure this out without turning to the internet. Initial means first. Public means that whatever is going on isn't restricted to some select group of people. Offering sounds as if the company is selling something. A good guess of what an initial public offering is would be the first time that a company sells something to the masses. If we deduce that, then the only thing we'd be missing is what the company is selling. It might be a new product, but in a course titled How the Stock Market Works, they're probably selling shares in the company's stock to the general public for the first time. And it's so often the case with finance, a little common sense gets us the right answer. An IPO is the first sale of stock by a privately held company to the public. Usually the company will be a smaller firm, often relatively new, and looking to grow more rapidly than it could without tapping a new source of funds. Why do companies go public? Let's see if we can come up with some reasonable guesses. First, who's selling the shares? The simple answer is the company, but if we remember that a corporation is just a legal shell that we wrap around a bag of goodies, then we realize that what we really mean is that the current owners are selling the shares. Put yourself in the place of a guy who started a company and built it over time. You may have sold a part of it to a partner, but you still own a big chunk of it. You might be worth $100 million, but $90 million is tied up in the company. That's not the recipe for a good night's sleep. You're not diversified, and a corporate disaster can wreck all of your hard work and financial success. Not all companies that have IPOs are still controlled by the founder, of course, but it's almost always the case that whoever does own the company at the time has a huge stake that didn't used to be so huge. That's one reason companies go public. The owner wants to cash out, either to diversify his holdings or perhaps to raise some cash to change his lifestyle. We said owner, but the odds are that there are several owners. When you brought your brother Tony on board as a partner, he bought 10% of the company. Now, he wants to cash out and take early retirement, but he just can't do that because he can't find a buyer for his 10% stake. Your money is all tied up in the firm too, so you can't buy him out. He's not happy about that, and that means you have an unhappy employee and an unhappy business partner. That's bad. You wouldn't have this problem if the firm were publicly traded. Shareholders gain liquidity by going public. Another reason firms go public is to make it easy to offer many employees a stake in the company's future. Sure, you could hire a team of lawyers to handle the documents to sell a small part of your holdings to your employees every time you needed to do that, but that just doesn't make sense. It'd be too expensive and time-consuming. Going public solves that problem. When a company grows to more than 500 shareholders, then it has to start filing a lot of documents with the SEC. Sometimes private companies decide that once they have to incur the cost of doing that, then they might as well take the plunge and go public. For example, Google went public about the time that it had to begin filing SEC documents in 2004. Keep your company founder's hat on for another minute. Suppose that business is good, and you could probably double earnings over the next couple of years if you could open a branch office and manufacturing facility in another part of the country. But that sort of expansion isn't cheap. Where are you going to come up with, say, $300 million? This is probably the main reason for having an IPO, to raise funds and have better access to capital markets going forward. You'll also attract the attention of analysts and pick up some credibility with customers, suppliers, and employees. Going public has drawbacks, though. IPOs require lots of legal work, and that's not cheap. The total direct costs associated with taking a firm public are about 7 to 10% of the amount of money raised, and that doesn't include indirect costs like management time that gets diverted from other corporate needs. I mentioned that IPOs require lots of legal work, so how does a company set about going public anyway? In principle, it doesn't sound too hard, does it? Just create the shares on a computer and sell them. How hard can that be? It turns out that simply issuing shares and selling them leaves out two important things. First, there's the legal system. The government won't let you issue shares and sell them without jumping through the appropriate legal and regulatory hoops. Maybe those hoops are a good idea, and maybe they're not, but they exist, and you have to jump through them or you're not going public. Second, what's the share price going to be? Remember lesson 12 when we tried to get a handle on corporate and share valuation? We learned that it was really hard. It's next to impossible for a private company. For a public company, we have lots of data and a reference point, the price history of the shares. We can't do that with a private company. The stakes are higher too. If you sell 2,500 shares from your personal portfolio and settle on a price that's $2 too low, then you've left $5,000 on the table. An IPO might have 25 million shares. A mistake of $2 per share would cost you $50 million. We need help. We need somebody who has done this before. In fact, we need somebody who does this sort of thing a lot. We need an investment bank. That's a financial institution that serves as an intermediary between the securities issuer and the investing public. They decide the best offering price. Investment banks also help with mergers and corporate reorganizations. Investment banks even provide advice before they start the issuing process. They might help us determine the size of the issue, or perhaps suggest that we delay the offering until market conditions or the company's prospects improve. Investment banks engage in a process called underwriting. Members of underwriting syndicates usually take the responsibility for selling the shares the company allocates to them at a specific price. The origins of the word underwriter seem to trace to a practice of having each risk taker write his name under the total dollar amount of risk that he or she was willing to accept. Today, it usually has a more general meaning, referring to the process by which investment bankers raise funds from investors on behalf of corporations. Want to know another reason for a company to use an investment banker when it goes public besides expertise and familiarity with the process? It's because IPOs are plagued with what financial economists call information problems. Remember when we discussed information problems in Lecture 3? In the case of an IPO, management knows a lot more than anyone else about the company's prospects, and they've decided to sell now. Not last month, not next month. Why? Now. Management holds all the cards. They decide when to go public, they decide what news to release, and the incentive to overhype is powerful. Founders of companies talking about their companies are like grandmothers talking about their grandkids. They're excited, enthusiastic, and optimistic. And that's just fine. They should be excited, enthusiastic, and optimistic about their companies. But most people don't want a sales pitch from that kind of guy. They want straight talk from someone who has done this before with a reputation for doing it right. They want someone who has a lot to lose if he messes up this deal. Investment banks fit the bill. Potential investors can check their track record. Those investment bankers need investors to say nice things about them after the deal to potential future clients. They can't afford to ruin their reputation. I've been saying investment bank as if IPOs involve only one such firm. That's fine for smaller issues, but for larger issues, the firm assembles an underwriting syndicate. An underwriting syndicate is a collection of investment banks that pool resources to sell new securities to investors. The lead underwriter might be some firm like Goldman Sachs, and other participants might be Citigroup, Bank of America, Merrill Lynch, or smaller firms like SunTrust Robinson Humphrey or Raymond James. The underwriting syndicate's job is to get the securities into the hands of investors and to get the proceeds from the sale into the issuing company's coffers. The lead underwriter does the heavy lifting. It'll analyze the company's financial statements in light of current market conditions, project its future earnings, and with the help of potential investors, determine the number of shares to be sold and the offering price. That's a tough job, and the skills needed to do it don't come cheaply. The total sales charge for the shares is around 7 or 8% for IPOs. Sometimes just a couple of successful IPOs or stock offerings a year can be enough to meet an investment banking firm's earnings targets. It's not just tough, highly skilled work. It's boom and bust work too. If you enjoy working 8 to 5 and then clocking out to enjoy life, then a career in investment banking is not for you. During the boom near the end of the 1990s, investment bankers were working incredibly long hours and making huge sums of money. But when the market collapsed in 2007 and 2008, even the best investment banking firms struggled mightily. Many failed, including the venerable Lehman Brothers, with roots tracing back to the 1850s. Job losses in the investment banking community soared as the underwriting industry came to a standstill. A lot of the syndicate's work isn't financial at all. It's legal. Somebody needs to complete and file dozens of complex documents. For example, a company will probably file several iterations of the registration statement, known on the street as the red herring. The red herring is a preliminary registration statement filed with the SEC. It gets its name from a passage in red stating that the company is not attempting to sell its shares yet. Think of a red herring as a rough draft of what will finally happen. It describes the new issue of stock and takes a guess at how the issuing company will do in the future. When I say takes a guess, I'm not being critical. At this point of the process, nobody knows the value of the securities. After all, they do call it a red herring. Any number that's in the red herring would just be a guess. I'd know it's a guess, you'd know it's a guess, so does everyone else. Most of the time, a red herring doesn't even have the price or number of shares to be sold. The red herring will be revised several times as the underwriting process proceeds. If you found an old coin in your backyard, how would you set about determining its value? You'd probably show it to people who know about such things, including a few potential buyers. That's what investment bankers do with an IPO. They call it the roadshow. They travel around the country delivering presentations designed to drum up interest and to answer questions from potential investors. They're gathering information too. By listening to the potential investors, the investment bankers begin to get a feel for what the offering price should be. You might think that investors would try to mislead the investment bankers by pretending to have little or no interest in the offering. If they can convince the investment bankers that the securities aren't worth very much, then they might be able to persuade them to set an offering price that's too low. The problem with that tactic is that when the securities are offered for sale later, the investment bankers will allocate them partly according to the amount of interest the investors displayed during the roadshow. Even if the investors have managed to fool the investment bankers into setting a low price, they won't get many shares at that low price because they didn't show much interest. That means they won't make much money. Telling the truth pays. There's a lot of give and take involved too. Because investment bankers expect to have lots of other deals in the future, their reputation matters, so they have incentives to treat the security buyers well. Eventually, the investment bankers will decide that they have enough information to set a range for the offering price and settle on the number of shares to be offered. They'll incorporate this information into the red herring, make a few other changes, and eventually call the resulting document the prospectus. The prospectus is an official legal document. The Securities and Exchange Commission requires that the prospectus contain the information that you need to make an informed decision about the stock offering. That's part of the reason that a prospectus is also called an offer document. Before the underwriting syndicate takes the shares to the public, it'll sometimes have a pre-IPO placement. That means that some of the shares get sold to private investors just before the IPO takes place. Typically, these private investors are big players in the equity markets. They usually get a discount from the offering price because they're buying in quantity. Some people think that's not fair to small investors. The big players counter that it's a lot easier and cheaper for the underwriting syndicate to sell 1 million shares to one private investment firm than it is to sell 1,000 shares to 1,000 different investors. Investors who buy shares in the pre-IPO placement also agree to lockup agreements. The underwriting syndicate doesn't want the participants in the pre-IPO placement to turn a quick profit by reselling their shares at the offering price immediately after the IPO itself. A lockup agreement is a legally binding contract between the underwriters and the purchasers in the pre-IPO placement. A lockup period can last for as little as 120 days or as long as a year. Probably the most common lockup period is 6 months. Some firms are willing to take the risk of pricing the shares too high and being unable to sell all of them. That'd be bad because the firm won't raise the right amount of money. These firms enter a best efforts arrangement with the underwriters. The underwriter promises to make a serious effort to sell the entire issue. This keeps the risk of the sale with the issuing company instead of putting it on the underwriters. That's good for the underwriting syndicate. The bad news for the underwriting syndicate is that its fee is usually fixed. It can't benefit if the offering is a huge success. Some firms, though, aren't willing to leave the possibility of a failed offering to chance and want to transfer that risk to the underwriting syndicate. They want to know for sure that they're going to sell all of the shares at the offering price and get a specified sum of money out of the deal. Underwriters will agree to that, for a bigger fee, of course. They might enter a firm commitment and purchase all the securities directly from the issuer for sale to the public at the price specified. Or they might choose a standby agreement in which the underwriter agrees to buy all unsold shares at the subscription price. They amount to the same thing, and in fact, the terms get used interchangeably sometimes. In both cases, the underwriting syndicate can end up eating stock, as they say on the street. Investment banking firms understandably hate to eat stock. In its IPO on June 28, 2013, technology products retailer CDW had to cut the offering price of its shares to $17 from its expected range of $20 to $23 per share, right before the IPO. And that's just part of the story. CDW also reduced the number of shares offered by about 3.5 million. Coupled with the price reduction, that means that the IPO proceeds fell short of expectations by somewhere upwards of $150 million and as much as $240 million. Let's look at CDW's IPO a little more closely. Documents that CDW's underwriting syndicate prepared said that CDW estimated that it would net about $370 million. CDW did something very smart in those documents. It listed how it planned to use the proceeds. It would use $344.2 million to redeem 2 debt issues and would also pay accrued interest on other securities. Telling investors how you plan to use the proceeds of a security issue is a good idea. That lets them decide whether or not they like the idea and want to participate. That's much better than saying the issue is for general corporate purposes. Hey, a raise and a company car for me are both general corporate purposes, right? But you probably wouldn't want to buy securities if the proceeds will fund my raise and my car. General corporate purposes sounds so much better. Investors have learned not to play those games unless they get a steep discount on the shares. Unless you want to sell your IPO shares at a steep discount, tell the buyers exactly what you'll do with the proceeds. The reports filed shortly after the IPO showed that CDW used 3 lead underwriters, and the names are familiar: Barclays Capital, Goldman Sachs and Company, and JP Morgan Securities. The rest of the underwriting syndicate contains some familiar names too, including Bank of America Merrill Lynch, Morgan Stanley, the German powerhouse Deutsche Bank Securities, and several relatively smaller players, including the Williams Capital Group and Loop Capital Markets. If we kept looking through CDW's reports, we'd see that the transfer agent was American Stock Transfer and Trust Company. A transfer agent records people and institutions that own a company's stocks and bonds. Usually, companies outsource this to a specialist. American Stock Transfer and Trust is one of the major players in this area. Next, we might see several housekeeping items, like the company name, address, phone, and website. We'd learn the share price for sure. For CDW, it was a disappointing $17. Only 23,250,000 shares were offered, and they brought in a disappointing $395,250,000. No current shareholders sold shares as part of CDW's IPO. That's good. Insiders usually know more than others about the value of their company. In general, if insiders are selling, then I'm not buying. Sales by existing shareholders are less important for IPOs than when a public corporation sells additional shares, though. In those offerings, called seasoned equity offerings, the share price tends to fall by more than 3% because the market sees that the current shareholders won out. Usually, letting insiders add their shares to either an IPO or a seasoned offering is an expensive perk. CDW didn't make that mistake. The documents for an IPO also list the number of shares outstanding after the offer and contain 2 bits of industry jargon, the lockup period and the quiet period. Remember the lockup provision? In CDW's case, the shares sold in the pre-offering phase couldn't be resold for a 180-day period that ended on December 24, 2013. The quiet period expired on August 6th, 40 days after the offering. The SEC imposes a quiet period because it thinks companies might try to hype their stock to drive up the price. No promotional publicity allowed. CDW and its underwriting syndicate seem to do most everything right, but the offering still can't be called a smashing success. CDW had to scale back the size of the issue and the offering price. What happened to the share price that day? It closed at $18.37, up about 8% from the offering price. That sounds like a good return for one day, and it is. But remember, just a couple of days earlier, the expected range was from $20 to $23. Settling at $18.37 is a disappointment, especially when we see what happens to the typical IPO later. Some other companies that went public about that time didn't do too well either. In hindsight, CDW went public at a bad time. Investors who participated in 3Com's IPO of its Palm division on March 2nd, 2000 were a lot happier at the end of the day. Palm was riding high because its latest device, the Palm 7 series, could actually, get this, access the internet without using wires. Palm expected to offer at a price between $30 and $32, but it actually offered at $38. It jumped almost immediately to $145 per share before closing at $95.06. At $95.06, Palm's total corporate market value was worth more than double the market value of Apple. Another well-known IPO is Facebook. Professors Andrei Kirilenko and Professor Andrew Lowe says that Facebook's IPO was the third largest IPO in U.S. history when it went public on Friday, May 18, 2012. Talk about hype. In early 2012, the issue of more than 337 million shares was already oversubscribed. That meant that there was demand for more shares than Facebook would make available. If you think that CDW's and Palm's stock price behavior on the IPO day is lots different from the rest of the stock market, then you'd be right. Unlike normal stock transactions with thousands of traders, IPO prices are set by negotiation. That means that they can be off by a lot, either too high or too low. It turned out that Facebook's offering price of $38 was a little too high based on the first day. True, it closed at $38.23, but it only managed that because the underwriters bought Facebook's shares after the offering to keep it from falling below the offering price. Facebook went into a long slide almost immediately and was between $20 and $25 per share for most of 5 months from August 2012 through the end of the year. By that measure, the offering price was way too high. VA Linux's offering price turned out to be way too low, to be fair, on the opening day, and way, way too high for a year or two later. VA Linux offered at $30 in December 1999 and closed that day at $239.25. That's a return of not quite 700% in one day. That sure looks like the underwriting syndicate left too much money on the table and VA Linux got a bad deal. Yet, by 2002, it traded below $1. Yes, I said $1. Okay, that's extreme, but IPOs do behave much differently than seasoned shares. Professor Jay Ritter has studied returns on IPOs for years. During the years 1980 to 2012, there were 7,704 IPOs with data he could use. Some IPOs had bad first-day returns, but the average IPO had a positive first-day return relative to the offering price for every single year. The average of those 7,704 IPOs returned 18.6% on the first day. This pattern holds internationally, too. IPOs from most countries, like Norway and Portugal, Thailand and Brazil, all seem to average big first-day returns. That sounds to me as if a good investment strategy is to get in at the offering price. On top of the economic reasons we gave for the offering price to be a little low, like investment bankers not wanting to eat stock, we have the evidence that seems to bear it out. If you do that, though, then get out soon. IPOs have a strong tendency to underperform the market during the 3 to 5 years starting the very day after the IPO. For smaller firms, those with under $50 million in annual sales, that's measured in 2005 dollars, the 3-year returns are beyond bad. They're horrible, more than 35 percentage points worse than the market. For larger firms, it's not so bad, but for firms with more than $50 million in sales, the average return is still 2.5 percentage points worse than the market. It only gets worse in years 4 and 5. I wish I could give you a good reason for this, but at this point, it's something of a mystery. In our next lecture, we'll explore some of the forces that affect stock prices, but which are out of companies' control. We'll learn that there are good reasons why investors spend so much time worrying about the national and world economy.